Hello traders, Gary Wagner here. It is 2:18 in Honolulu, 7:18 in New York on Thursday, 3rd day of March 2022, and this is the daily report for gold and silver. Gold prices continue to rise to higher ground. In fact, in the period of about a month and a half, we have seen gold gain approximately $158 as of today. Gold, basis the most active futures contract, is up $16.10 and currently fixed at $1,938.10. That is occurring concurrently with dollar strength, providing headwinds on the precious metals markets. Silver gained about 0.4%, a 9-cent gain, with March silver at $25.28. Platinum had a substantial gain of 1.41%, or $51, with the most current futures contract at $1,083. But again, it is the fact that Russia accounts for 40% of the global production of palladium caused that metal to rise by $112 today, over a 4% rise, with palladium futures currently at $2,777. My comments yesterday to the price decline in gold was that I believed it is a one and done type of event. That was based on the fact that it was simply a reflection of the fact that both Russia and the Ukraine went to the negotiation table, and the overwhelming understanding that they are so far apart in their goals that it would be impossible to come to some sort of conclusion, and in effect would end at a stalemate. Gold gained approximately $16 in trading today. It is currently trading overseas, up $2 above that at $1,938.20. I still believe that it is highly achievable that we will once again challenge the highs that occurred on Thursday. That occurred just following the invasion into Ukraine. And I think that if we do not see resistance at that area, we in fact could push much higher. Although we have been focusing on the effect of the invasion into Ukraine by Russian military, it cannot be understated the effect that that action is having on inflationary pressures. We are all acutely aware of the fact that inflation has spiraled out of control. It is prevalent across the globe. In the United States, the most current CPI, Consumer Price Index, is sitting at a 40-year high of 7.5%. The recent climb in crude oil, as well as the agricultural prices rising, almost assuredly mean that the next report will even go higher than the current reading. It is a given that come the next FOMC meeting later on this month, the Federal Reserve will announce and implement the first rate hike that has occurred since March 2020. Many individuals had believed prior to the invasion that the Fed is going to be much more aggressive and might even implement the first rate hike of 0.5% rather than 0.25%. They also had a hawkish view that we could see anywhere between 4 and 6 rate hikes this year, although the consensus among analysts have been that this year will result in a full percentage increase in the Fed funds rate, which brings us to the future actions of the Federal Reserve based upon the fact that the last CPI report indicated that inflation has risen to 7.5%. Of course, this data came out before the invasion, before oil began to dramatically rise. It had been on the rise, but not over $100 a barrel, and the rising agricultural prices. First of all, the rise in crude oil reflects every product that has to be transported from one place to another. So it will increase inflationary pressures across the board. Agriculture is a necessary component of living, feeding one's family. And so to raise interest rates and be more aggressive will only put more pressure on global citizens and on Americans to meet the needs, and therefore the Fed is in a precarious scenario in which they are definitely between a rock and a hard place, and the distance between the rock and the hard place continues to tighten. On yesterday's show, I talked about our initial price target, as I briefly mentioned today, $1,975 per ounce. We also talked about maintaining our stop at this current level. We will look to raise it soon if we continue to see prices rise. But if prices continue to rise sharply, what are the real resistance points that we could see over the next month to month and a half? And the reason I say that is because it appears as though the current crisis in Ukraine is not going to be resolved quickly, and in fact, will most likely get worse before it gets better. That being said, I want to take a look at our realistic targets that could occur during this leg of the rally because of the strong fundamental crisis that is currently in play. Of course, we talked about the price point at 1975. There is a price point just below that, which comes in at 1960, and that is fairly strong because it is based upon these two tops here, a double top, as the market hit a record high and then traded sharply lower. Above that is $1,999, rounded up to $2,000. It's based upon this top, but more importantly, the key psychological importance of that century mark. 2022 is based on this top here, and then above that, it has really no technical resistance until the record high of 2088. At any one of these points, we could see this market go into a corrective stage. However, as long as there's an escalation of the conflict in Ukraine, the likelihood is that gold will continue to be supported